Hello, friends. Welcome to today's session at GyaanStation. The journey of GyaanStation started in the year 2020, and in 2024, ITBA has joined us and it acted as a strengthening factor. It added strength to our platform. With the addition of AGFTC, TAG, and GSTPA, we were able to evolve ourselves and work on a next level. And finally, after partnering with Choice Group, we are on a better note now. So this side, CA Dipti Jain, welcome you all in very interesting session on taxation of non-resident individuals by Advocate Dr. CA Kartikey Shah. Friends, let me tell you, as I've already mentioned, it is the 5th year of our EdTech platform, and we have done more than 300 webinars with a vision to provide consistent knowledge, learning, upgradation, and unstoppable webinars to serve the professionals from diverse fields like chartered accountants, CS, CWA, financial advisors, advocate. 6 organizations have joined their hands together to serve the fraternity: ITBA, All Gujarat Federation of Tax Consultant, TAG, GSTBA, Gujarat Service Tax Bar Association, and The Choice. The object of webinar series is very simple: to update and brush up the knowledge of our professional brothers and sisters. So that when it's coming to your day-to-day daily professional routine, you can deal with your clients confidently and in a very innovative way. We can proudly say that we have also received awards and accolades at in many forums. So with this note, I here take the privilege to start our today's session. We have our eminent speaker. Sir, welcome. Kartikey sir, in today's session. We are very grateful to have you, and I also recognize the presence of CA Sridhar Shahji, the president of ITBA Association, and in his presidency, today is the last webinar as a president of ITBA. It's a sweet, bitter adieu to him, and I recognize the presence of CA Dr. Vishwesh Shahji, the president of All Gujarat Federation of Tax Consultants, and all our dear participants. As a guest, or I would like Shida ji हमेशा webinar को start करते ही welcome all our participant speakers. So here today I welcome him, and we would like to share his journey. सर आप अपनी थोड़ी जर्नी एंड एक्सपीरियंसेस शेयर करिए एज अ प्रेसिडेंट एंड वर्किंग विद all of us. Over to you, sir.
So I'll not take much of the time for this because everyone knows, and the journey can be seen on the social media handles of the Income Tax Bar Association. It's a continuous journey, and a president comes and go, another president comes. It goes continuous, just like knowledge should go continuous. So I would go with the today's session part only. So I welcome all the attendees to today's session, and we have a very good speaker with us today, Advocate Dr. Kartikey Shah. He has been the past president of Income Tax Bar Association and also holds doctorate in international taxation. And to an extent, I can consider he's a mentor to me too for this leadership position. So I acknowledge both the Vishwesh Bhai has been the first mentor I have ever had. And so it is nice to share the screen with both the mentors for me. And that's something a wish comes true kind of when your two mentors are there on your last program of the activity here. So over to you for the session, Dipti.
Thank you, Shita ji. I would like Vishwesh ji to please say a few words for Shita ji, actually.
Actually, Sridhar is a good guy. He is associated with me since 15 years, last 15 years. He has completed his articleships also under my principalship, and he is also now partner of my firm also. He is also continuing in all the way to with me. And Kartik is a very good friend of mine. Thank you.
थैंक यू एंड मैं कुछ बोलना चाहूंगी श्रीधर जी के साथ 2 साल हो गए हैं इट्स बीन 2 years जर्नी ऑफ मी सिंस आई कनेक्टेड विथ हिम और जहां भी लाइक यू कैन अंडरस्टैंड डूइंग एन ऑन गोइंग सीरीज ऑफ वेबिनार्स अगर आप इन सब में कहीं भी किसी ऑर्गेनाइजेशन में इफ यू हैव बीन इन एनी कमिटी इट्स अ वेरी चैलेंजिंग टास्क टू कम अप एवरी वीक विथ 1 or 2 webinars there are so many difficulties which we face so many glitches are there either last moment speaker change हो जाता है topic नहीं होता है कभी audience का there is a problem with respect to audience technical problem so many things are there but with the support of Sridhar ji and Ashish ji इनके पहले थे and now with all the organizations it has been a smooth road for us जैसे बोलते हैं कि when you go alone it's always difficult but when you have a team when you set big goals so you always need a team of like-minded people who are ready to work selflessly and we are really very grateful कि we have got this people this kind of team composition with us और श्रीधर जी तो ऐसा है कि without me knowing that he knows everything वो बिहाइंड द सीन इतना कुछ करके रखते हैं कि you just he make a cakewalk for the other person to work जैसे I would like to note that आज भी we had some problem with respect to the cloud recording and I was just speaking him on call just 2 minutes before कि आज recording नहीं हो पाएगा and श्रीधर जी just told me कि सारा recording का मैंने setup कर दिया है you can easily go through that cloud recording so this kind of support has been provided by him in every respect तो थैंक यू सो मच श्रीधर जी एंड इट्स बस आपका प्रेसिडेंटशिप का वो चेंज हुआ है otherwise your responsibilities has not been changed at all we will keep disturbing you and we will keep calling you और आपको ऐसे ही
Sure,
आना है
sure,
ठीक है
sure.
thank you so much for being there and coming towards today's session Kartikey ji is an excellent superb human being what a person he is and today I met him 2 years back in Ahmedabad, and today we are having him on our platform. So let me introduce him. He is the doctorate in philosophy in the subject of an analytical study on the growth and scope of international taxation in India from Gokul Global University, Singapore. He had done masters in law and bachelor's in direct taxes. His areas of practice lies in income tax, GST, international taxation, public charitable trust, constitutional laws, and contract act. He had started his practice as an advocate in the year 2011 in the areas of direct and indirect taxes and successfully handled compliances of filing of returns, audit practices, handling assessments under various sections appearing before quasi-judicial authorities such as commissioner appeals tribunals and administrative authorities. With respect to his co-curricular activities, he had conducted several lectures on various professional association platforms and he had been the youngest president of All Gujarat Federation of Tax Consultant in the year 2021-22, which consists of 2,000 individual tax professionals consisting of chartered accountants, advocate, tax consultants, and he had been president of ITBA and the member of Direct Tax Committee of Gujarat Chamber of Commerce in the year 2021. He has been the managing trustee and been member of several tax professional associations. He had been fitness enthusiast and health is wealth, very well. So he is maintaining both the thing, health, wealth and knowledge. All three aspects he is continuously working on. And with these words, sir, we welcome you in today's session. And we already crossed 240 participants. All are eagerly waiting for your knowledge apprehension. Over to you, sir.
Thank you so much, madam. Thank you so much for giving me an opportunity. President C.A. Sridhar Shah, Income Tax Bar Association. President C.A. Dr. Vishwesh Shah, All Gujarat Federation of Tax Consultant. Madam C.A. Dipti Jain, GyaanStation, Gujarat State Tax Bar Association, Tax Advocates Association Gujarat, and Choice, the Joy of Learning. This day, I am sad and I am happy both because Sridhar is a very dear brother. He is just like a brother and he has done an excellent job as far as the Income Tax Bar Association his year is concerned. And he is, I can proudly say that he is a technocrat, modern chartered accountant who knows technology very well and he knows the laws. So kudos to Sridhar and CA Dr. Vishwesh Shah. We are very good friends and he is a chartered accountant who has expertise in various fields. And Madam Dipti Jain, Jnanam Param Balam. So what you are doing, you are really contributing to the fraternity of tax professionals and salute to you for your work. I am sharing my today's presentation.
So can you a little bit increase the volume, please?
Yeah.
I think the sound is clear.
Okay.
It is clear?
Yeah, it is clear.
Yes.
It is absolutely clear.
Okay.
Is it visible?
Yes, sir.
Yes, we can start.
Okay. So friends, today's topic is taxation of non-resident individuals. So today, before starting of the lecture, I just want to convey that international taxation is a very wide subject and nobody can become expert of this. You can know many things which I don't know. So basically, it is all about sharing our knowledge. And I just want to say that screen is shared.
Yeah, screen is shared. તમને છે ને છેક નીચે બોટમમાં હોવર કરશો ને તો દેખાશે નીચે ત્યાંથી તમારી સ્ક્રીન શિફ્ટ થશે ત્યાં એક બટન્સ હશે.
So just sit back and relax and understand the basic concepts. I would please focus on the basic concepts, and I am 100% sure that after the end of this lecture, you will understand all the nitty-gritties of the international taxation, and you can solve your queries on your own. So with that, residential status. Friends, residential status is the most important limb as far as the international taxation is concerned. So international taxation is the taxation on the income of a taxpayer. So why it is a very important subject? Because it is a taxation of the income of the taxpayer, but that taxpayer is not limited to the India. There are two countries, and when two entities or two individuals of two countries get into the transaction, then the question of international taxation arises. So it might be possible that a person is a resident of one country and the income he has earned from another country. In that case, we have to understand the taxation aspect where he will not be levied for the double taxation. So it involves taxation of cross-border transactions. of either property which has been sold or any income which has been earned from other country. So residential status of taxpayer determines the incidence of taxation. Now the taxation from where it arises, it is very important. The incidence. So there are two types of taxation. Either it is resident based or it is source based. So resident based taxation means the person who is a resident of particular country, in that country he will be charged he will be levied the tax, or the source from where he has earned the income. That depends, that if he has earned any income from the different country, then that country has a right to levy the tax of whatever income he has earned. So for levying the tax for any country, the taxpayer's residential status has to be determined. That is the first step. The tax will be levied on the income, that we all know, and it is for the previous year. So any resident status has to be in context with the previous year. And that we will see again ahead. But residential status for every previous year of any taxpayer has to be determined individually. So it might be possible that for one previous year he is resident, and for other previous year he is a non-resident. So for any previous year, the residential status has to be determined. Section 231 of the Income Tax Act 1961 defines the term person. Now let's see the definition. What person includes? Person includes an individual, a Hindu undivided family, a company, a firm, an association of person, or a body of individuals, whether incorporated or not. A local authority and every artificial juridical person not falling within any of the preceding subclauses. So international taxation is not limited to any individual. It is levied on the person, and person includes what I have said, that individual, Hindu undivided family, everything is covered. So all these entities, whenever they earn any income from other country, then they are liable for the international taxation. Now, section 5, that is scope of total income. So what is section 5 suggests? That the scope of total income for different categories of tax. This section outlines what income is taxable in India based on the residential status of the individual or entity. So in and all, income, in what how income is levied, at what rate of tax it is levied, it all depends on your residential status. Now there are three categories: resident and ordinary resident, resident but not ordinary resident, and non-resident. So what is the difference? So the resident and ordinary resident, the tax will be levied on his global income. He is a citizen of India, and whatever income he earns from the India as well as from out of India, from any foreign state, everything is taxable and he has to pay tax. So now you will ask me a question, that how is it possible that whatever income he has earned in the foreign country, how he is taxable in India? He is taxable, but there are treaties that has been signed so that he will not levy for the double taxation. That we will see. So he will be taxable for the global income, and how he will be taxable for any of his income. That income received or deemed to be received, income accrued or arisen or deemed to accrue or arise in India, income accrued or arise outside India. So everything is covered. In any case, if he earns income, then he has to pay the tax. The second category is resident but not ordinary resident. Income. Now, what is the difference between ordinary and not ordinary resident? So everything is same, but the difference is not ordinary residents' foreign income is taxable if it is derived from a business controlled or profession set up in India. So if the person is not ordinary resident, then whatever foreign income which has no connection with India, whatever foreign income he earns, it has to be in connection with India, means either it is controlled by the business or profession set up in India. Otherwise, his foreign income is taxable if it has no connection with India. So that is the difference between ordinary resident and not ordinary resident. And the third category, resident. So it is taxable when he earns anything, any income from India. Speaking, the non-resident will be taxable only when he has any connection with India as far as the earning of income is concerned. So how these three categories can be determined? That is very important. But first of all, let us understand liable to tax. This is very important term. The meaning of the liable to tax in the context of treaties has been the subject of several court rulings. Friends, I suggest that you please read this Azadi Bachao Andolan. It is a case decided by the Honorable Supreme Court, and it is important because many conclusion has been drawn by the verdict of this decision. So some rulings have found that person is liable to tax even if no income tax law in force for the time being if a potent liability for tax exists. So what this verdict said that even if any country has no income tax law, still because of the earning of income, he is liable to tax. That was the ruling that has been decided in the past. But for nullifying this interpretation, Section 229 has been inserted by the Finance Act 2021 with effect from 1st April 2021. So for nullifying this interpretation by the decisions, Section 229A has been brought, which says that liable to tax in relation to a person and with reference to a country to mean that there is an income tax liability on such a person under an existing income tax law in force of that country. So this section clearly says that if a person is liable for the tax, for the income tax, then in any country, then that country must be having income tax law existing if they want to tax any person as far as the taxability is concerned. So it has been clear that if any country like UAE, it has no income tax law, so you cannot tax a person as far as Section 229A is concerned. Now, it is very important, that is Section 6, for deciding the different categories that we have discussed, resident, ordinary resident, not ordinary resident, how they can be derived. Section 6 of the IT Act sets out the provision of how different persons are treated as resident in India. So for proving any person resident in previous year, there is a condition that has to be followed by the person for recognizing him as a resident in India. An individual is said to be resident in India in any previous year if India in that previous year for a period amounting to 182 days or more, or 60 days in previous year in last 4 preceding years more than 365 days. So this is the basic condition that we need to take care for person to be proving himself as a resident in India. Either he must have spent 182 days or more in the previous year, or more than 60 days and more than 365 days in the preceding 4 years. with either or condition, then he can be recognized as a resident of India. So there are new provisions and relaxation has been brought by the Finance Act about the Indian citizen or person of Indian origin. So who is person of Indian origin? A person shall be deemed to be of Indian origin if he or either of his parents or any of his grandparents was born in undivided India. So any Indian citizen who has gone to India for the purpose of employment or any person of Indian origin. So in that case, 60 days limit has been replaced to 182 days. Why, friends? Why these limits are very important? Please understand. If the person is a resident, he has been proved as an ordinary resident, then his global income is taxable. Mind well, his global income is taxable. But in case of non-resident, his Indian income is taxable, and whatever income he earns in foreign country which has no connection with India, that is not taxable in India. So that's why these conditions and proving the residential status is very important, because once you have been proved as a resident of India, then your global income will be taxable in India and you have to pay tax. So this is the crux of understanding why we are understanding all these conditions. I hope I am clear. So for Indian citizen or person of Indian, 60 days limit has been extended to 182 days. Why? Why 182 days? Because if he has visited India, he has complied, he has spent more than 60 days in India, then he might fall in the ordinary resident category. So that's why for saving him with the unnecessary residential status thing, this has been extended, this has been relaxed to 182 days. For that, the another condition is his income, Indian income does not exceed 15 lakh. So understand my point that the 60 days will be extended to 180 days only when your Indian income does not exceed 15 lakh. Now, if any Indian citizen leaves India for the purpose of employment, so it doesn't mean that only purpose of employment includes the salary income. It includes the self-employment. Means if a person is leaving India to establish any business or profession in the foreign country, then also it will be given a relief by this section. So it includes self-employment. And the third category is Indian citizen who is a member of crew of an Indian ship. He is also entitled for the 182 days relaxation. Then another relaxation, what has been brought, that 60 days limit will be extended to 120 days. He will be relaxed for the 120 days if his Indian income exceeds 15 lakhs. So relaxation of 182 days when Indian income is less than 15 lakhs, but relaxation of 120 days only his Indian income exceeds 15 lakhs. Everything else is same. Now, friend, one important concept has been is deemed residence. So what is deemed residence? In case of deemed resident, even if you have not spent any single day in India, but if you earn any income from India which is more than 15 lakhs and you are staying in any country which has no income tax law, or you are not supposed to pay any tax in that country as far as your earning of income is concerned. So इसमें ऐसा है कि भाई जब आप ऐसी इनकम जनरेट करते हो जो दूसरी कंट्री में टैक्सेबल नहीं है और 15 लाख से ऊपर आपने इंडियन इनकम अर्न की है, then the government has brought a concept of deemed residence. So by that, even if you are not staying in India for a single day, but you are having citizenship of India and you are earning more than 15 lakhs rupees from India or connection of India, then you will be liable to pay tax in India. Just like UAE, it has no income tax law. But you are staying in UAE, but you are earning income from India in any way. And if it exceeds 15 lakhs, then if it exceeds 15 lakhs, then you will be liable to pay tax in India. So this is the concept of deemed resident. It is very important. Please keep in mind. But deemed resident is not liable for any tax as far as the foreign source income is concerned. And the last, not ordinary resident, if any taxpayer is has spent 9 out of 10 years, any non-resident tax, if the person is non-resident taxpayer in any 9 out of 10 years or 729 days in 7 years, then he will be treated as not ordinary resident when he leaves his position of non-resident. Now the non-resident. So now we have seen that what is called ordinary resident, what is called not ordinary resident. And the last category is non-resident, whose Indian income is only taxable, whose foreign income is not taxable in India. So it is implied that if he stays less than 60 days or less than 365 days in last 4 years, then he will be termed as non-resident. Now, friends, what we have seen is the individuals, which is determined by the physical presence. Please understand, this word is very important, physical presence. The individual's physical presence, individual's residential status is determined through his physical presence. Now, what about other entities? Like Hindu Uniteded Family, firm, or other association of person? Then in that case, it is very simple. Every entity is treated as resident, except control and management of its affairs is situated wholly outside India. So, as far as these entities are earning through control and management, which is in India, they are liable to pay tax. Company is said to be resident in India if first condition is Indian company or its place of effective management is in India. This is the very important concept which has been brought, the place of effective management, because it has been brought from AY 2017-18. Means from 1/4/2017 for considering the residence of company, the place of effective management concept has been brought. Before that, what happened? The control and management words are there. So what companies were doing, that somehow they are showing that the control and management, they arrange the programs or meetings like that out of India. So they want to say that our control and management is out of India, and hence whatever income we are generating, that is India has nothing to do with it. So for that, for curbing these practices, specific amendment has been brought, and now the control and management words has been replaced by place of effective management. So we will understand the definition of place of effective management. Now, what we have seen about the deciding the residential status is according to the domestic taxation law, which is Indian Income 1961. But friends, we all know that there are treaties, and India has entered into the treaties among the 90 countries. So in treaties, how they decide the residency? So there are tiebreaker tests where one by one they go to the criteria and they decide the residency. So the first criteria is permanent home test. So the taxpayer has a permanent home in any country, then he is the resident of that country. The second is center of vital interest. If he has many important work is running from the particular jurisdiction or particular country, means his vital interest has been defined by the particular country, then the second criteria, according to that, residency will be decided. Then habitual abode test. Now we have to understand what is habitual abode. So in that, a taxpayer is not living in his permanent home country, or he is not running his affairs from a particular country, but and most of the time he spend his time from that place. Then, according to habitual abode test, if the person is spending his most of the time to a particular place, then we have to see the place, the country where that place is situated, and according to that, we have to consider the residency. And then nationality test. If he has a national of any particular country, then he is the resident of that country. And if all these tests fail according to the treaty, then both the countries decide mutually that how they will share the revenue of the taxation from the particular transaction of a taxpayer. Now, what is split residency? So, mind well that in India, in particular previous year, only one category of residency can be announced. So it is not like that in previous year, half of the year a person remains ordinary resident, and for the other year a person remains non-resident. So once he has been declared ordinary resident, for the entire year, he will be treated as an ordinary resident or treated as a non-resident. Both cannot be possible. It's called split residency. So this concept is not valid in India. There are some judicial precedents as far as the residential status is concerned. So there are certain points because of the judicial precedent that has been derived and which we should keep in mind. So we have to understand that if the person, if the Indian citizen is going for the employment, that includes self-employment, but the purpose should be of employment or running business or profession. It should not be like tourist or medical treatment or studies. In that case, 182 days or 120 days, relaxation cannot be available. Now we have seen employment would include self-employment, means a person is going for rendering his services as a businessman or a professional, he will get the relief. Now, sometimes the type of visa that has been issued to you, accordingly, you will be treated for the residency criteria. If you are issued the tourist visa, then it cannot be termed as for the employment purpose. There are certain decisions and the conclusion, which is very important, that we have to understand for the broadening our understanding for the international taxation. So it is said that in Annamalai, normally it is Karta who has control over the. So we all know that in HUF, all majority the Karta will take the decision, but that doesn't mean that if the Karta is not present, the control and management is not in India. So in absence of Karta, if other members are are having control and management, then also it is the income will be termed as HUF income. There are other also cases. Now the most important thing is if the person is ordinary resident or not ordinary resident or non-resident, that has to be proved by the taxpayer. And for that, he has to keep all the documents intact for proving his residency criteria. So that burden of proving the residential status is on the taxpayer. Now, in one of the case, Honorable Supreme Court has expressed what is control and management. So control and management means factor control and management, and not merely the right or power to control and manage. Means it should be on the platform, it should realize on the platform that the entity has been controlled and managed by the India. It doesn't suffice the purpose that you give any right or power to particular person, and it seems. So it should be in factual. So as I said that earlier, for treating the company as resident, in the second criteria, the control and management word has been, so it has been misused by the entities for so long, and the amendment is brought, and the place of effective management, that has been, the words has been brought. So place of effective management is defined in the act to mean a place where key management and commercial decisions that are necessary for the conduct of the business of an entity as a whole are in substance made. So it is not like that if you arrange any meeting out of India, and you can say that the entire year has been, the income of the entire year has been decided by only that meeting, and so that we can say that control and management has been proved by the meeting which has happened in out of India, and so all the income cannot be taxed because the control and management is outside India. So that they have brought this amendment to include the words place of effective management, means that series of decisions proves that any control and management, where the control and management exists. So it is not about keeping one meeting. It is about for the entire whatever decisions or whatever management you are doing, and out of that whatever income you earn, and according to that you will be liable for the taxation in it. So place of effective management is a very deep subject. Now, friends, we all know that we all have suffered the phase of COVID-19, and in that case, it happens that many non-residents who have come to India, and they have to stay compulsorily because everything has been stopped, and because of their stay, their residential status has been converted from non-resident to ordinary resident. So in that case, relaxation has been given because it was the genuine situation. So the Delhi High Court held that his presence in India against his will or without his consent should not only be counted. So it happens in COVID-19 that a person has to stay compulsory, whether he wants to stay or in India. So in that case, he is staying in India against his will, and because of that, those days should not be counted, and hence it has been brought that the days the SSD spent in India involuntarily, so against his wish should not be counted. A similar relaxation has been provided to individuals who had come to India on a visit before 22nd March 2020. So now we all know that in international taxation there are two aspects. One is domestic taxation law, and the other is treaties. The taxation of any taxpayer decided by the domestic tax law, but treaties are there to remove the anomalies of double taxation. But in treaties, there are also criteria for residence, and in domestic taxation law, we have seen how the person can be treated as ordinary or non-resident. So there are always conflicts. It might be possible that in domestic taxation law, a person is treated as ordinary resident, and in treaties, they can be treated as different person. So in that case, what we have to believe? So basically, it has been said that a person should be levied tax as per the residence status derived by the domestic taxation law. The forms and the guidelines require only residence status under the Act to be declared by the SSC. None of the written forms require SSC to fill in his treaty residence. So even whatever returns or whatever forms, even in tax residency certificate, they are asking for the residential status of an individual as per the Income Tax Act and not as per the treaty residence. But in some countries, it is possible that they are avoiding the local domestic taxation law and they are following the treaty residence criteria. Like in Canada and United Kingdom, that in domestic tax law, it has been provided that when a person is resident of another state for the purpose of tax treaty, the person will be regarded as non-resident for the purpose of domestic law. So it is, if anything has been provided specifically in the domestic taxation law, that if the person as per the tax treaty has been treated as a particular residence, then we have to follow that residence criteria. Then at that time, we have to see that what is the residence status as per the tax treaty. Or else domestic taxation law specifically suggests how the person can be regarded as any resident or non-resident. So friends, we have completed with the residential status. Now, there are certain income tax provisions applicable to non-residents that we see. Just a second. So as we had seen that how the income will be levied. So anything which is received or deemed to be received, accrued or deemed to be accrued or arising, in that way, the resident or non-resident or ordinary resident will be taxable. But the main thing is, the main point is, ordinary resident, his global income will be taxable, and non-resident, his only Indian income is taxable. Foreign source incomes are not taxable at all of non-resident. Now, what are the incomes for that non-resident has to pay tax? What are the different incomes? So the first is salary income. So if any services are rendered in India by any non-resident, salary income is taxable. Okay. So if non-resident in any way he earns any salary income from India, he is taxable and he has to pay tax. Now the second other income is rental income from property located in India is taxable. We all know, we have not discussed here the Act of FEMA, but as per the Act of FEMA, any non-resident can purchase any kind of property in India, but what he cannot purchase or possess, that is agricultural land or and farmhouse. So as per FEMA, non-resident cannot acquire any agricultural land and farmhouse, or else he can acquire any property, whatever he wishes. So if any property has been purchased by non-resident and if any rental income is generated, then that is also taxable. And it is subject to TDS under section 195. All other laws are same. So if the NRI owns more than 2 properties, then up to 2 properties, if he has not rented it out, he has just possessed, he has not rented it out, the annual value of the 2 properties can be considered as nil. And the third property, if he has not let out, then it will be understood as a dim let out. Friends, all the criteria for earning an income and levying of tax are same for the non-resident, just like ordinary resident. So there are no special rate tax. Non-resident is also leviable as per the normal slab of income tax, and all the income are same whatever resident is earning. If in that case, if non-resident is earning, he will be liable for the tax. So there is no difference. But the difference is regarding the deduction of TDS. Now, gain from the immovable property. So any capital gain arising from the immovable property or sale of shares of Indian company are taxable. So if the non-resident is having any shares of Indian company, listed or unlisted, if he sells, then he has to pay tax. Now, sale of immovable property. Capital gain arises only when the property is sold or transferred. Sale consideration includes the value of any consideration in kind. Expenses Hello. Expenses incurred wholly and exclusively in connection with the transfer. Okay. So what cost of acquisition includes? It includes actual purchase price paid, expenses incurred, stamp duty, registration fee, and brokerage. Okay. But it doesn't include the advance maintenance. Any maintenance paid for any property cannot be included in the cost that we all know, or any outstanding property tax or related that is not included. But in case of non-resident, it is very important. If he wants to sell any property and he comes straight away from the foreign company to India and he has incurred any expenses like airline expenses and all that, those expenses for the happening of sale of property, then all those expenses he can be allowed as a deduction at the time of calculation of capital gain, but that is a subject matter of litigation. So if any non-resident incurs any expenses for the sell out of any property, then he can be allowed as deduction, mind well, but it is a subject of litigation. So any ordinary routine repairs and renovation expense, he cannot be allowed. This is very important. Any cost of improvement before 1st April 2001 cannot be considered as far as the deduction of cost or expenses is concerned from the sale. So any cost of improvement before 1st April 2001 cannot be considered as expenses. So straight away after 1st April 2001, we are taking the base year as a 1st April 2001. So that's why. Now, we all know that once the non-resident sells any property, and if he wants to remit the amount out of India, then he has then Form 15CA has to be filed, and Form 15CB has to be filed by the has to be prepared by the chartered accountant that decides the tax. Now, what are the other incomes for the non-resident? Interest earned on any fixed deposits, NRO accounts that we see later on, or any loans. Any interest income is taxable. Interest from NRE and FCR is exempt. Kind of dividend received from an Indian company, that is taxable. Royalty or fees of technical services. Any foreign company earns anything which has been in connection with or permanent establishment in India or through agent, then that foreign company is also taxable as far as its earning of income is concerned. Now, foreign portfolio investors. Foreign portfolio investors are regulated under SEBI and are allowed to invest in listed equity shares, corporate debt instruments, government securities. Right? So they are also liable to pay tax in India. They are primarily taxed on capital gains, interest income, and dividends. Foreign portfolio investors. But the most important thing is foreign portfolio investors are not allowed to take the deduction of any indexation. They are not allowed any deduction or indexation benefits, and they do not get the benefit of the basic exemption limit. So this is restricted for foreign portfolio investors. Straight away, they have to pay tax on capital gains, interest income, and dividend, but they are not allowed for any deduction, indexation benefits, or basic exemption limit. Now, this is a special rate section has been brought for the non-resident. It is not mandatory. If non-resident doesn't want to follow this special rate, they are allowed and they can be levied the tax as per the normal. But let's see, a non-resident Indian can opt for this special tax regime only in respect of income derived from foreign exchange asset or long-term capital gains arising from the transfer of such asset. Foreign exchange asset. So basically, what is foreign exchange asset? The asset which has been denominated in foreign currency, and if it is sold, then in that case, under this section, a non-resident can straight away pay the 20% tax, right, without getting into the normal tax leverage. And he will not be allowed any deduction or any expenditure for the deduction, and not even benefit of indexation. And if any sale of immovable property which has been done, then if under section 115F, it has been invested in shares of Indian company or debentures or deposits or security of central government, then it can be, it will be allowed as a deduction, and for that on long-term capital gain, non-resident will be exempted for paying tax. Foreign tax credit, this is very important. So the non-resident, it doesn't only earn income from India, it also earn income from foreign. So foreign tax allows Indian, it is about Indian resident. When Indian resident, we have discussed that Indian residence is liable for its global income. So whatever income has been earned by the Indian resident taxpayers in foreign, at that time he has paid tax in foreign. For that he has to take credit. So foreign tax credit allows Indian resident taxpayers to claim credit for taxes paid in a foreign country. Right? So under section 90 with double tax DTAA, or section 91 with no DTAA. So he will be levied tax, either lower of foreign tax paid or Indian tax. Whatever the lower income is, lower tax is there, it will be allowed as credit. For that, he has to file Form 67 and proof of foreign tax paid. So he has to show the foreign income in his return of income, and he has to file Form 67 in addition and proof of foreign tax paid, so that he can get the tax credit under section 90 or 91. And whatever lower, means whatever foreign tax paid or whatever tax he has to pay in India for that income, whatever lower, that will be allowed as credit. So this is very important, foreign tax credit. So basically, this credit is allowed and suffice the purpose of avoiding double taxation. So as normal taxpayer, even non-residents are, they are also being assessed for the scrutiny assessment, base judgment assessment, reassessment, transfer pricing assessment. They can also go in the appeals, CIT appeals, tribunal, High Court, Supreme Court, up to High Court on a substantive question of law, and up to tribunal on a question of fact. There are other also dispute resolution mechanism for the non-resident. So dispute resolution panel, DRP, it is all, only non-residents are eligible, like foreign companies, used for transfer pricing or international taxation issue. Then mutual agreement procedure for resolving DTAA, treaty issues. This authority has been designated to solve these DTAA issues and advance pricing agreement. Now, friends, please keep in mind what are the important documentation any non-resident or any person who is going as an immigrant in other country and they are having green card, and now in 1 or 2 years their status will be changed from ordinary resident to non-resident. So at that time, what kind of precautions you have to take in the form of documentation? So calculation of number of days of, so this is very important. Please keep in mind this thing. Calculation of number of days of stay in India. You have to calculate for each previous year your number of days stay in India that can be derived from the stamp of the passport. You have to take care of passport copies. Then whatever asset or whatever investment you are doing in the foreign country, being immigrant and staying in the foreign country, all the relevant documents you have to maintain properly, right? Then all the tax returns and other documents, whatever you are filing in the foreign country, that you have to maintain. Then you have to disclose one way or another if you have to file tax return in India, your foreign assets. So all the details you have to keep intact, your employment contract, salary slips, and your purpose of immigration or emigration, the whole story from where you have applied for the immigration and on what basis you have been granted the immigration, that whole story and whole documents you have to keep intact, because anytime either from any country the officials will ask you in the future that how and what is your journey being non-resident from ordinary resident. So, friend, as we have seen what the DTAA and treaties, we have heard a lot about it. But why this and what is this? So, a treaty is a formal, legally binding agreement between two or more countries or international organizations governed by international law. So, all the countries come together to give the special benefit all the taxpayers of world for not being taxed twice. So, for that, all the countries get into the agreements or treaties for saving the double taxation of their taxpayers. So if one, right, so this is the treaty and they are having important place, and the formation of treaty foundation has been laid down under Vienna Convention law. So there are three models of forming double taxation avoidance agreements. So these models help any countries to form various articles. And who are they? OECD model, Organization for Economic and Cooperation Development, UN model, US model, and Indian model. But most popular is OECD model. So friends, DTAA and treaties are very important to understand. So now I want to share something that in international taxation, what we have to take care. So once any non-resident or resident earns an income, then he will be liable for taxation. We all know. So we have to determine his residential status. Then we have to see the domestic taxation law. Then we have to see the treaties between two countries, how they will be charged the tax, and for as far as the foreign income is concerned, how they will be allowed the tax credit. So most important is domestic taxation law, but treaties are also important for understanding the levy of tax for any taxpayer of any country. So this is, I said that Azadi Bancha, madam will share the PPT. Please read this. You will understand what is the basic purpose of forming any treaty or DTAA between any countries. It might be possible that both the countries are so much heavy for making their benefit possible, and ऐसा होता है कि भाई जब ट्रीटी फॉर्म होती है तब दोनों कंट्रीज पुश करती है कि भाई हमको बेनिफिट मिले। तो अभी ऐसा होता है कि जब ट्रीटीज फॉर्म होती है तो उसमें बहुत सारा कॉम्प्रोमाइज होता है। तो इस केस में यही कहा गया है कि sometimes there is no use of forming any treaty, but treaty is important because the basic concept is also important and it has to be mentioned because every country has their domestic taxation law. But what about the common agreement between any countries? And unless and until if you have no common agreement between two countries, then the possibility of double tax avoidance agreement cannot be removed. And for that, treaties have so much importance and we cannot remove the importance. Even honorable courts have also understood the importance of treaty and so that treaties should be there. And India has entered into treaties with 90 countries. So these all are the judgments regarding the treaties and DTAA. Please go through it. We are running short of time. Now, the most important concept I want to share with you: NRO, NRE, and FCNR account. I know you have a lot of confusion about operation of these accounts. So first, we understand non-resident external account. This account is denominated in Indian rupees, wherein proceeds of remittances to India can be deposited in permitted foreign currencies. So friends, NRE account, in NRE account, it is non-resident external account. It can be opened by non-resident, right? It can be maintained in permitted foreign currency. So it is denominated in Indian rupees, but all the remittances, all the deposits that has been done in foreign currency, and non-resident, ordinary resident cannot open NRE account, right? So monies are freely repatriated in or outside India. So there is no restriction as far as the repatriation in NRE account is concerned. But please mind well and please focus for these 10 minutes. The important concepts is NRE in account, you cannot deposit Indian rupees in cash, or you cannot deposit any income generated from India in Indian rupees. I hope I am clear. So basically, you have to deposit any foreign currency and it should be operated by non-resident. Ordinary resident has no right to operate NRE account. So any foreign income. So basically you will ask me a question, then why NRE account is there? So NRE account is specifically for if any non-resident earns any income in foreign country, and dividend, pension, interest, then he must have earned in foreign currency. Then at that time, that entity will deposit that foreign earnings in person's NRE account, right? So it will be deposited in foreign currency, but it will be converted straight away by the receiving bank according to its exchange rate. Okay, so this is very important. So it is for any earning of foreign income in foreign currency. It is subject to just a second. It is subject to exchange rate fluctuation, right? So interest income earned in NRE account tax free. So I hope I am clear with what is non-resident external account and interest income earned on NRE account is tax free. Now non-resident ordinary account. So friends, what is non-resident ordinary account is if any person in 1 year is ordinary resident and because of his employment or because of other reason, if he is living India and now his status is going to change of non-resident, then at that time he has to inform this particular bank to convert his ordinary bank account to NRO account, non-resident ordinary account. or he can straight away, because of his residential status, he can straight away open non-resident ordinary account. Now, what we have seen in NRE account, that it can only foreign currency can be deposited, foreign income earned in foreign currency can be deposited in NRE account. Now, the NRO account is completely reversed. So any Indian income or any cash deposit in Indian rupees will be can be deposited in non-resident ordinary account. So any non-resident, if it earns any Indian income in Indian rupees, if he wants to bring that money or repatriate that money in its country where it's living, so for that he has to use the NRO account, because any Indian income in Indian rupees or cash deposit in Indian rupees can be deposited in non-resident ordinary account only. I hope I'm clear. So NRO account can be opened by a non-resident for any bona fide transaction. What I said, that if any non-resident earns any income in India in Indian rupees, he has to open NRO account and repatriate that money to its country where he is living, right? And NRO account can be opened by resident also. So repatriation from the NRO account. So in NRE account, repatriation is free. There is no restriction. But in NRO account, for any financial year, US 1 million USD can only be repatriated, not more than that, in any financial year. This account allows you to receive remittances in permitted currency from outside India through banking channels of permitted currency tendered by the account holder during his temporary visit. So NRO account also receives money, but it will be straight away converted into Indian rupees. As I said, income earned in India can be deposited in NRO account. It is also subject to exchange rate fluctuation, and interest income on NRO account is not tax-free. Now, foreign currency non-resident account, it is specifically a term deposit account and not a savings account. So monies can be deposited as per the RBI's regulation, and it is a term deposit account, so only you can earn what it interests. And the principal amount of interest earned from the deposit are fully repatriable. This account is not subject to exchange rate fluctuation. Deposit and withdrawals are in foreign currency, right? So there is no exchange rate fluctuation because it is not being converted in Indian rupees. It remains in foreign currency. You have to deposit in foreign currency, you have to earn interest in foreign currency, and it remains in foreign currency. So there is no scope of exchange rate fluctuation. And income earned from FCNR account is tax-free. Then there is special non-resident rupee account, SNR, purpose of letting, right? So it is for the specific purpose. Purpose of putting through bona fide transaction in rupees as a special non-resident rupee account. So in earlier, what happens that some foreign company has to show its establishment and its local bank accounts for running any projects. Now the facility has been given to all the foreign entities that you can open special non-resident rupee account for particular project, and after the completion of project you can close that account. So for those persons, this account facility has been brought. Then escrow account, the account can be opened for acquisition and transfer of capital instrument, convertible notes, right? Now PPF and SSY account for NRIs. So please mind well, now the rules has been changed for the NRI as far as the public provident fund and Sukanya Samruddhi Yojana account is concerned. From 1st October 2024, and NRI will not be given any interest, means they will be given 0% interest on their PPF account, and now they cannot open any PPF account, and NRI cannot open Sukanya Samruddhi Yojana account, right? Now, tax residency certificate, it is very important. A tax residency certificate is an official document issued by the Income Tax Department of India to individuals or entities proving their status as a tax resident of India for a specific financial year. So friends, mind well, without tax residency certificate, you cannot claim tax credit, you cannot prove your residency, and you cannot take the benefit of treaties or double tax avoidance agreement. Tax residency certificate in any countries must to prove your residential status and to take the benefit of DTAA through foreign tax credit. So tax residency certificate is the basic document. It is used for claiming DTAA benefits, as I said, avoiding double taxation, withholding tax reduction, right? So in any if income is arise and it has been taxed in domestic taxation, it is taxed more, and in treaties it is less as per the percentage. Then with the help of tax residency certificate, you can withhold tax and you can reduce the tax yes, so that as per treaty they will be charged less tax. So for lower TDS, tax residency certificate is important. And establishing your residency, either it is Indian tax residency or any foreign tax residency is important. Now, any resident taxpayer, for any resident taxpayer, you have to file Form 10FA for getting tax residency certificate, and Income Tax Department will issue Form 10FB, right? And if you are a non-resident, then along with tax residency certificate of your own country, means of your foreign country, you have to file Form 10F to claim all the DTAA benefits. So Form 10FA is for Indian resident taxpayer, and you will get certificate in 10FB, and 10F is specifically for the non-resident to take the benefit of DTAA. So there is a CBDT circular which shows that in absence of TRC, it states that TRC is only. So ideally, as per the law language, it is not necessary that without TRC you will not get the benefit. But technically, now we can see that tax law is different and the workings of CPC is different. So even in tax law, we are getting benefit, but we have to follow the CPC procedure. Like that, in DTAA, it is not necessary that you need tax residence certificate to establish your claim of avoiding DTAA or foreign tax credit. But for getting that credit, you must possess tax residence certificate, because in forms they are asking for the details of TRC. Now, friends, the exchange of information by nations, now the world has become a very small marketplace, and even all the governmental organizations are also updated, and they are working in unison. So now we have to be very much aware. International taxation now is most important subject for learning and for as far as your tax compliance is concerned. If you are having different businesses in different countries, and you cannot ignore, because there is a sharing of information by different countries. Now the first is FATCA, Foreign Account Tax Compliance Act, that is of USA. The Account Tax Compliance Act is US law that mandates foreign financial institutions to report information about financial accounts held by US or residents. So as per the FATCA, now all the Indian government is getting all the information about investment, income, or possession of any non-resident who are connected to India from the US government, and it is vice versa. So if any US citizen has any connection with India, so Indian government will also share the all the details regarding financial or tax compliance to US government. So please beware. Now they are exchanging information, and they have a lot of information that we cannot even imagine. So there is no time to hide anything. We have to disclose everything, and we have to be compliant. Other is automatic exchange of information. So it is under the OECD, and it's a global forum on transparency and exchange of information for tax purposes. So all the countries are exchanging, have started, and they are exchanging information in bundles. Now double taxation avoidance agreement that we have seen, tax information exchange agreements, right? So this is another agreements that has been signed by the countries for sharing the particular information, and this is important. Tax information exchange agreements is agreements to get the information from the tax havens. So all the taxpayers, for saving tax and for hiding their other incomes, if they are investing in tax havens now, investments from tax haven countries. Then other bilateral and multilateral agreements in G20 and BRICS, we have seen all the transparency between these G20 countries and BRICS, and because of that, deeper corporation of tax transparency and financial data sharing has been started, and it is going very well. Now, friends, the non-resident aspect is over, but now it is very important for the resident. That is disclosure and source of foreign assets. Since AY 12-13, Indian residents are required to disclose their assets located outside India in their income tax return form, not required to file a tax return. So friends, please beware, this is very important. Even income tax department has issued an advisory video on their channel, YouTube channel, and now they are very much serious about the disclosure of any foreign assets in the income tax return, and they are connecting it with Black Money Act, and they are charging heavy penalties if you are not disclosing. So we are seeing what kind of disclosure we have to do. And CBDT has prepared itself, and they have formed 14 investigation directors, foreign asset investigation units in 14 investment of resident in foreign. So there is lot of information they are getting, and if there is any violation as far as the disclosure is concerned, there is a penalty and imprisonment in Section 10 of Black Money Act. So in ITR form, there are different places where we have to disclose the different aspects, the unlisted equity shares, then directorship, if you are having any directorships in any companies, then asset and liability schedule here, the resident has to show the global assets and not ordinary and non-resident Indian asset. Then foreign source income are included in the total income. So if you are earning any income from the foreign sources, you have to show in Schedule FSI and Schedule EI income exempt under the Income Tax Act or DTAA. So what are called as foreign assets? This is very important. Foreign assets refer to any form of asset or holding that a resident taxpayer owns in a foreign country. So this is all about resident taxpayer who are having investment in foreign country and not in India, investment in foreign country. What are these investments? That is foreign bank accounts, any bank account maintained outside India, including saving account, fixed deposit, other financial accounts, financial interest in foreign entities. So it might be possible that any LLC or any outside foreign company, you have an interest either in directorships or either a managing partner or whatever. If you have any financial interest that you have to show in ITR, if you are having any immovable property, as I said, that non-resident can purchase immovable property in India. In the same way, our resident can purchase immovable property in foreign countries. You have to show that immovable property, then foreign securities, any shares purchase of any foreign country companies, you have to show other capital assets. What is foreign income? If you are earning any kind of income in foreign, that salary, rental, interest, dividend, capital gain, business income, you all have to show. This is very important. Schedule FA, foreign assets. So what the assets, investments, or income, what we have discussed earlier, if you have anything in foreign country, then you have to show in this schedule FA, foreign assets. And mind well, I have mentioned and I am again mentioning that if you are not having any income beyond the exemption limit, or if you are not having any income in India, still if you are having these investments, or any income in foreign country, you have to file return and you have to disclose these assets under Schedule FA. So you cannot escape if you say that I don't have any income, so I am not supposed to show these assets. No, you have to show these assets even if you are not earning any income in India. So these are the Schedule FA details of foreign assets, foreign depository accounts. They are asking for different information, country name, country code, name of financial institution, address, everything they are asking in detail. So you have to be ready with data and which is accurate. Foreign custodial accounts, foreign equity and debt interest, foreign cash value, insurance contract, financial interest in any entity, immovable property, what I have said, capital asset, and the interest, financial interest. If you are related to any trust created in foreign, then you have to mention that also. Now the Black Money Act. So why disclosure of foreign asset is so important? Because of the levying of hefty penalty and imprisonment, and in a serious case, they are also implementing prosecution. So that is because Black Money Act Section 10. So the act applies to all resident taxpayers who hold foreign assets or earn foreign income, right? What we have discussed. It covers the entire spectrum of foreign assets, including bank accounts, properties, securities, and financial interest in foreign entities. Mind well, let me tell you, suppose someone asks that we have not disclosed in earlier returns about our investment or income. So what can we do? So Subrasya Sidram, if you have not disclosed in earlier returns, please start disclosing in the upcoming returns. So if you still follow the same mistake what you have done, you will definitely attract the penalty. So please disclose whatever you are having and from the upcoming returns. And penalty for non-disclosure: failure to furnish the ITR in relation to foreign income and asset, or to report such foreign income and asset located outside India in the ITR, may attract a penalty under Section 42 or 43 of Black Money Act of an amount of 10 lakh rupees. So there is no any less amount, directly straight away 10 lakh rupees if you even failure to furnish. Once you failure to furnish under the Black Money Act, you will be charged 10 lakh rupees, and regardless of the value of asset, regardless of the value of asset located outside. In certain cases, criminal prosecution, what I have said, criminal prosecution can also be initiated, which may result in imprisonment for up to 7 years. So it is a very serious matter. But there is some relaxation if any asset other than immovable property. So if you are having immovable property, anyhow, you have to disclose their property. But if you are having any other liquid investment, and if it doesn't exceed the value 20 lakh rupees, then you are exempted from the disclosure, right? Then the penalty, sorry, not disclosure, but the penalty will not be levied if the amount does not exceed 20 lakh rupees. So this is the Black Money Act, and I hope I have completed in time. Thank you so much. International taxation is a wide subject. Nobody can be expert in international taxation. But as much as we learn this subject, we get to know the different nitty-gritties of the subject, and it is very interesting subject. We have to learn this subject. Even though we are not practicing in international taxation, we must be aware of all the aspects, all the compliance aspects of international taxation, because it's a future of taxation. With this, I conclude my speech.
Thank you, Kartikey Bhai. There are a few questions. We'll take the questions first. So it is already 6:30, and we'll take 7 or 10 questions. So there is a question. Okay. So there is a question related to DTA with Singapore. It is a very specific question. So I would prefer to answer the general questions, which can help lot of participants. So there is a question by Prakash Thakkar. So, sir, can you please give one example of income accrues or ariser or deemed to accrue or arise in India and how it is different than the income received or deemed to be received? So I think the idea is
So
income.
basically,
Yeah.
it is very simple. The one example you are asking is about the 5 years fixed deposit, where you are not getting interest income in cash every year, but there is a cumulative deposit concept. So for that, your income is generated, but it is not received in cash. It is received after the completion of cumulative deposit period. So it's called accrue or arise, but it is not received in cash.
Okay. There is a question that is RNOR status withdrawn from AY 2026, it's the new act, and now only resident and non-resident status.
So right now, income tax bill 2020 has not come into effect, so we will not discuss about it. Right now, income tax act 1961 and all the provisions are applicable. So I think it will be applicable from 1st April 2026. So right now, not ordinary resident status is there.
One of the person has TIAA CREF in retirement fund in USA, and now he wants to withdraw fund from that retirement fund. Is this withdrawal is liable to tax?
So basically, we have to be very clear. Please understand this thing. You have to understand the source of the income, right? So if you have invested anything and you are earning, if you have invested anything in foreign country and you are earning anything from the foreign country, that is your foreign income. And whether withdrawal or any difference means except the capital, the difference of amount is taxable or not, we have to see the domestic tax law of that particular country. And accordingly, it will charge the tax. As a resident, it will be your global income and it will be taxable in India, but you will also get credit of whatever tax you have paid in the foreign country.
There is a question from Prakash Thakkar, 15 lakhs of income to be seen from India for deemed resident. I think it is not having any context related to what kind of income. I would prefer to skip it. That is a question from
So let me clarify. For deemed resident, any income in connection with India, either it is in generation of India
Okay.
or having any source of India, then it is proved. If it is beyond 15 lakhs and if you are staying in any country where there is no income tax law, then you will be charged in India for earning that income.
Okay. There is a question from Suresh Amerias. As per section 6 into bracket 1A, deemed resident will always be treated as resident but not ordinary resident, and he is not liable to pay tax in India for his foreign income. So even if in foreign country where he is resident, he is not liable to pay tax there like UAE. Whether such individual have to pay tax in his foreign income, although same is not taxable outside India.
No, I stated very specifically that not ordinary resident, his foreign source income will not be taxable. For not ordinary resident, his foreign source income will not be taxable. Only for ordinary resident, his global income will be taxable.
Whether such deemed resident who is always RNOR has to disclose his foreign bank account and foreign assets in ITR.
Basically, it is all about resident taxpayer. Either he can be an ordinary resident or not ordinary resident, but still he's a resident taxpayer. So he has to disclose. Non-resident is not coming under the purview of disclosure of foreign asset, but any ordinary resident or not ordinary resident, both have to disclose.
Okay. Will deemed residency be considered while treating income from sale of Indian property of an NRI?
Of an NRI?
Non-resident, will deemed residency be considered while treating income from sale of Indian property?
No. This is a mix of concept. Deemed residency is for the resident Indian citizen who is staying in a country where there is no income tax law. And if NRI is having any property, if he sells that property, he will be chargeable and he can repatriate according to the 15 CA CB procedure.
If a company is set up and registered outside India, then whether it is said to have POEM outside India?
If it is set up and registered outside India, but there is any connection, any place of effective management, or there is any connection regarding his commercial decisions from India, then his income will be taxable. So it is a matter of litigation, and you have to prove that it is not at all related to India.
A very tricky question. What if few key decisions taken in one jurisdiction and few key decisions taken at another jurisdiction, where decision at both jurisdiction are key decisions, then what will be the POEM?
So basically, that's why there are quasi-judicial and judicial authorities to solve the matter. There are also arbitration. So these are all litigation points, and if there is there is no compromise, then we have to. I am afraid we have to go for the litigation thing because we need order for proving any point.
Okay. So there is a question. I'm looking at the interesting questions. Sir, please guide on source of exchange rates to be taken to convert foreign income. Adding on the same question, income up to December for relevant year to be reported and exchange rate on March ending of the same year to be taken.
So basically, what I've said that you have to see the exchange rate as per the bank you are depositing foreign currency. So the whichever receiving bank applies exchange rate, that we have to decide. And what you are asking is the exchange rate that we have to take care, that has been specified by the RBI every day. Whatever exchange rate that has been declared by the Reserve Bank of India, that we have to consider.
So there are a lot of questions. We are actually ended the session.
So
I will take two questions.
questions.
There are so many questions. I'll request you to take 2 or 3 more questions. I'm just
You can
trying
me
to.
also.
Yeah. So I'm trying to find out which is a little bit different. I'm just trying that. Okay, fine. In the chat box, I am going and let me check a question which is different a little bit. So there are so many things which is covered in the session, questions which were asked earlier of the time. So there were already answered. So do NRI get indexation benefit for property of sale before 23 July 2024? That is a question.
That I need to see. So I will.
Yeah, because it is part of this section which is charging the capital gain, right? Okay. So let's end it. There are so many questions, and I request all the participants, if you have a question, the mail ID is in the last screen. Also, the PPT will be shared and it will be having the email ID. So you can share your queries with the speaker and he can answer the same. So on the
one
closer.
last thing I want to say, I really want to thank and express my gratitude to all the organizers, all the participants who have spared this important time from their life to hear me. And I hope I have fulfilled your expectation. And thank you so much.
So the expectation cannot be fulfilled because this is a subject which has a great number of questions, and there are questions which are at times remain unanswered, not available on public forums at times. So yes, an expert need help is required. Also, in case-to-case basis, you have to apply all the fundamentals. So it is, but yes. I think it is the future of the profession where everyone can be able to work in the foreign taxation, international taxation, may it be the individual part or the company's part, all these things. And I request the participants to share their feedback in the chat box. It is As I also told yesterday, it's a vitamin which keep us running, and it shows how we can add value to all the participants' life. I would request the Secretary of GSTBA, Advocate Ashutosh Thakkar, to propose vote of thanks for today's session. Ashutosh bhai. Over to you, Ashutosh bhai, if you can. Okay, I think he's having some issue with the mic also. So, on behalf of all the four associations, Choice Group and GyaanStation, I would like to propose a vote of thanks to Advocate Dr. Kartikey Shah for a wonderful session with insights on international taxation with respect to non-resident individuals. There were so many basic things covered in the session, and this is a subject where basics, clear basics, is the must to understand the next things. When we are filing a return, we simply click the resident, non-resident, even before application of all these fundamentals. So, and RNOR and non-resident, there is a thin line between that part, and we at times miss it. Also, the foreign assets and income disclosure part for resident, that is also an important thing, especially when people are investing into overseas stocks and having their even the businesses are having their interest in the overseas entities. So a session which is very helpful, and thank you for that, and thank you all the participants. We have also shared the detail of the next session. Please join for it. That is on risk management in option trading, a very specific subject, but yes, very informative and required subject. So with this, we end the session. Thank you all.